Thanks for having
And
me.
Brent, I was also on our investment committee. Thank you for joining us.
Well, thanks, Lon. Great to be here.
So thank you guys for being on our webinar tonight. We're going to talk a little bit about commercial trends on a national level. You should see there's a chat box on the right-hand side. So feel free to type in questions or comments as we go, and we'll try to address anything you guys bring up as we go here. So how many of you guys would like to know a little bit about today's supply and demand balance, which will help to influence what we get for future rent, occupancy, and concessions? And how do you want to, learn how to use this to kind of make better decisions about what to buy and when to buy it? So our goal tonight is to give you a lot of the raw material to make those kinds of decisions, and not just kind of rely on what you hear at the coffee shop or see on CNBC. Let's see. So we're going to go through some live case studies today. I'm going to show you as much hard data as we possibly can, and Brent's going to do most of the talking about the case studies, which are really the fun part of the equation. So just from the attorney standpoint, none of this is going to be a claim of income or that, anything that you want to make a decision for an investment on just for what we talk about tonight. The information we provide, definitely review it with your financial advisor, your CPA, and your attorney to figure out how this sort of investment might fit into your overall investing plans. And what we'll go through this evening is not an offer to invest. If you would like to learn about our funds in more detail, I'd be very grateful to share that with you later, and we can go through that in as much depth. But tonight's really just about knowledge sharing. So I'll show you how we look at deals from a raw material standpoint on the trends, and Brent will help me out with that. Yeah. For the team, most of you probably have been on multiple webinars from us. So the investment committee is myself, Brent, and Vital, who is on vacation in Greece. So he's probably just finishing up dinner right now because it's probably 2 a.m. there. But each of us have a lot of years of experience working in investment real estate. So the thing that we try to specialize in to make life easier for you is that we work on passive investing so that you don't have to fight with all the battles of changing laws and dealing with tenant requests and things like that. And if you could put your investments on autopilot, then you're well on your way to getting to financial freedom, which is really what most of us are trying to accomplish here today. So just a quick overview on the types of funds that we offer. We've got a national diversified fund. Usually those return over 17% a year, and they're about a 5 or 6 year commitment. This fund 8 that we're working on right now is closer to was it a 22 or 23%, Brent?
23 was the latest numbers.
Yeah, so that's our best one that we've ever done. So I'm really grateful for that. We have a short-term income fund that pays between 8 and 9%, and it's tax advantaged, and it's very liquid. We have a medium-term income fund that also pays a quarterly dividend like the short-term income fund does. It pays between 11 and 13%, but not quite as liquid. And then we occasionally have single asset funds like Hill Point, which will be coming out in about a month or so. All right, so that's all of the administrivia. So the key message that we want to talk about tonight is that we're expecting that we're going to have mostly flat rents nationwide, although there'll be some variability from one market to the next in 24 and 25. And we're going to talk about why that is and why we think it's going to be an incredible market opportunity for multifamily in 26, 27, and 28. We'll talk a little bit about capital markets as the number of transactions is down tremendously, and there's a lot of money sitting on the sideline, and there's an increasing amount of pressure for that money on the sidelines to get deployed. We'll talk a little bit about housing starts for distress. I think Brent's got a fun deal that we looked at that we can talk about for that. And if we have time, we'll talk a little bit about construction costs. And hopefully you guys will throw out some topics for us as well. So structurally in the US, we're just really short of housing, both for sale and for rent. And the reason for that is we just have not been building enough. And this is a great chart that shows a little bit about the amount of new supply of housing, rent and for sale, that was built relative to the population growth rate over a 25-year period in a number of industrialized countries. And what you can see is that Poland has done a good job of keeping up with their population growth. And among all these different countries, we've done the worst job of basically not keeping up with population growth. And that's a big part of why we see home prices are accelerating faster than wages. And up until recently, there wasn't quite enough apartments to go around. That's going to be a temporary blip that we'll talk about.
Yeah. And Lon, when you take a look at that list, we're one of the few that will actually do a 30-year fixed mortgage on a home as well. which just compounds
Yeah.
the problem.
Yeah, I mean, if you were like in Poland or Austria, I think they'll lock the rate for a couple of years, and then it's a floating rate for everybody after that, right?
Exactly. Again,
And I
I'm
think
not a
about
specialty in all of those, but I know several of those, and most of them are floating initially or floating after an initial fixed period.
Yep. It's interesting, I know Germany, because I lived there for a while, the percentage of people that rent is closer to 55 or 60% of the population versus in America, it's like 35%. So the mortgage terms that Brent referred to have made it a lot more accessible for first-time buyers here to be able to afford to buy versus in Germany, they can't. So they end up being trapped as renters their entire life. But solve one problem and I haven't solved the other one. So a number of research groups have estimated that we're going to need about another 1.7 million units by 2030. And there's a number of different data points here on different sides of shortfall that we've got. I don't see any easy path for us to be able to build the number of units that's going to be required. So I think the supply-demand imbalance is probably going to stick around for quite a while. What that means then is that there'll be upward pressure on rents and home prices. That's the overall macro trend for probably at least the next 5 to 7 years.
And Lon, the new news here in Denver just recently is they're considering a sales tax increase for more affordable housing. And again, they think they're going to tax their way out of it and not regulate their way out of it. But I digress.
No, I think that's a really important thing. The cost to build a rental unit now is in the $250,000 to $300,000 per unit range, and the sales tax that they're talking about, I can't remember how much it was going to raise, 50 million or something like that, but it was enough for several hundred units or maybe in the low thousand of units, but it's nowhere close to what we would need. But it would certainly add a tax burden, making our market a little bit less attractive to people who want to relocate here, which is unfortunate. I guess that's one way to solve the problem. Fewer people move here, there's less of a housing shortage. Maybe that's what they're really trying to accomplish.
A backwards way of doing it for sure.
Bureaucratic thinking. So there's a big bubble of construction that's going on right now. So the reason for that is if you rewind to about March of 22, so 2 years and 5 months ago approximately, that's when the era of the really cheap interest rates and very accommodating monetary policy ended. So from the start of COVID, let's say, that was like March of 20 through March of 22, we had this glorious 24-month window where into the economy as fast as they possibly could, and the banks were very accommodating. So what that meant is we had very, very low interest rates, and it was easy to get projects through loan committee because nobody was really worried about much of anything. So a lot of real estate developers all brought projects simultaneously to their loan committee saying, hey, we'd like to go build some more product, all pointing to this structural supply-demand imbalance I talked about a couple slides ago. So for some markets, they signed up more projects to build than were probably necessary. We're going to explore that in a little bit more detail in a minute. And the reason is you've got 40 different developers talking to 40 different banks, and of course none of these guys are talking to one another because they're all competitors. And if you needed 20 new apartment complexes, you get 40, then you'll tip over the supply-demand dynamic for a little while in that market. So you can see that the number of new apartments that we're expecting to deliver in the middle of 24, 25, in the very early part of 26 is just under 700,000 units versus we've usually been on like a $350,000 delivery, 350,000 unit schedule. So just about double the number of units that you'd normally anticipate. So we'd expect that delivering this many units this quickly, at least in the downtown areas for a product, you're going to see flat rents to declining rents just because it'll take a little bit of work to absorb all those units. And I'd expect that every one of these developers has investors putting a lot of pressure on them saying, how soon can you lease this up? So there'll probably be some rent concessions to make that all happen. Most of you guys on this call that are active investors probably own C quality product. That's what I have in Aurora. I don't have like an A building in downtown Denver, so I can't afford that. So we won't be as directly impacted by this, but we will see the overall market probably be just a little bit softer. That's if you have multifamily. If you have a single family rental, or like Brent, you've got condos and townhomes, right?
Absolutely.
I don't think your market segment is really impacted by new apartment buildings built downtown. What are you seeing from a leasing standpoint?
I'm seeing strong activity as long as I'm priced, at the right at the right value for that unit. I'm fixing up things a little bit nicer than I used to because there's a little bit less competition for the units, but overall the rents are still remaining very strong.
That's good. And that kind of reflects what I've seen in suburban office as well, is that I've got to do a little more rehab than I would have pre-COVID. And I've got to be a little bit more flexible on terms, but I'm still getting rent increases and I'm still staying really, really occupied, as opposed to the office buildings downtown, of course, are all like really, really struggling. So the huge tsunami of new apartment construction that started during the 2020 to 2022 period is just now starting to deliver. It'll deliver over all of next year and a little bit of the year after that. What you're going to see after that is that there's not going to be much. So if I go back to this, you can see the anticipated deliveries in 27 are quite a bit below the long-term average. And the reason for that is once the mortgage rates started going up in the spring of 22, the banks also tightened up their lending standards quite a bit. So instead of needing 25% down for a construction project, you might need 35 or 40% down. And a lot of developers just couldn't make the math pencil out with that much equity into their projects. So the number of projects that got launched really collapsed a lot. And you can really see that at the bottom part of this 2026 and 2027. So what we need to do is be ready to endure a little bit softer rents, a little higher vacancy, a little bit more on the concessions for probably about the next 2 years, let all of this new inventory get absorbed. Then behind that, there's not a lot of new inventory getting constructed. In Denver, it like went from a really high number to almost nothing, partially because of the lending environment, partially because of a lot of requirements for improved insulation, improved energy efficiency, improved concessions being given for affordable housing. That just made everything about building for rent product a lot less attractive. And that was what, 18 months ago or so, Brent?
Yes.
Yeah, so people rushed to get their products in before the deadline, and then there hasn't been a lot of activity since then. So how much will this impact different markets? Well, it's going to vary tremendously. So these are the top 5 markets where new units are getting added. And I don't think that's very useful just in and of itself. So I divided it out by the population of the city. And what you find is that Austin is many units. New York City, although it's adding a lot of units, it's such a huge place, it's probably about the right amount, and there's a couple data points in between. So as we underwrite deals and think about where we want to invest, this is one of the things that we're thinking about, is that we don't want to be going into a market like Austin. We want to be going into, like, a lot of our Hill Point projects, for example, are in rural Georgia, rural Alabama, South Carolina, and Florida, where we might be the only construction project, and the rents are solid and the vacancy rates are low. And if we're going to be the only one in the near term adding capacity, we can feel pretty confident that we're not going to mess up the rents. Brent, do you want to talk a little bit about like Hill Point, for example, how they underwrite when they're thinking about a new market?
Absolutely. So, the interesting thing with Hill Point is they come in with some just great product, quartz countertops, 9-foot ceilings, very nice fixtures and everything. Amongst the nicer product you'll find for the attainable or affordable category. And when they go in and underwrite these rents in a new market, they underwrite it against really the 90s and 2000s product that's already there existing in the market. And that's what they use for their comps. So when they bring this brand new product to the market, and again, once the units themselves are great, but the whole complex is extremely well done with workout facilities, resort style pools, cabanas, etc. So, I mean, it's no competition when they bring this brand new product into the market against these, 90s and 2000s comps. They blow them out of the water. And that's why we see such strong results there. And, we do a little bit on the investment committee to take out what I would call the sandbagging of that effect and take a look at what some of the returns are. But again, it's not our job to, completely alter their returns or really mess with their returns. We just want to take a look at kind of what the effect is when we think it will come to market. And the bumps are always well above. And again, these are projects that function as is on the 90s and 2000s comparables. Fully underwritten, 8% return on asset. I mean, just great stuff. And so when they come out to the market, it's unbelievable what they return. And that's part of the secret to their success, along with vertical integration.
Yeah, that's one. I really like the degree of conservatism that there's a lot of things that could go wrong and they can still make their numbers, and I can still not get in trouble with any of our limited partners.
They are a pleasant surprise every time I talk to them.
Absolutely. So let's talk a little bit. I'm going to show you I want to show you absorption first. I'm going to come back. So this is absorption for fourth quarters of 2014 through 2023. And you can see that we've had good absorption in 23 in the fourth quarter, much better than it was in 22. So absorption just means that there were, if there were vacant units overall in the market, that there were new renters coming into the market to absorb or take away that inventory to push the inventory of vacant units down. So we had a pretty strong amount of absorption in the fourth quarter of last year. And then this is the exact same chart looking at first quarter. And we had a gangbusters first quarter of 24 for absorption, best by far in the last decade. I don't have data going back further than that. It might be the best number in the last 20 years. So we delivered about 135,000 units nationwide, and we absorbed just about all of them. So if the new supply and the new demand in a given period are pretty close to matching, you'd expect that the vacancy rate would be relatively stable and that rents wouldn't really go up a whole lot, maybe inflation, but not much more than that. So that was really strong. I don't know if we can pull that stunt again in second quarter, but so far that's doing pretty well. Go ahead.
I was going to say, if labor market remains strong, I think we can.
I think we may be able to.
My initial gut on some of this activity when it first came out, specifically in Rhino and other things, was they're just burning through their interest list, and let's see if it keeps going. But it seems like it has kept going past the initial interest list, which is very encouraging.
Yeah, and if they've got a decent amount of demand, that means they're not having to throw a lot of concessions at it, and that they can actually get decent renters on the first pass, not wait to hurry up to lease the building with all these people that are $200 below market, and then try to raise them all $200 when their leases come up, which that's a tough lift to do. Yeah. So it definitely leads to a lot better economics when you're trying to sell the building, as soon as you're occupied.
Yep, absolutely. So, I was going to say, we just need to remember the profitability for these guys, like any retail enterprise, is always in the last, 20% of what they lease, not the first 20%.
Yeah. I mean, getting the building from 0 to 80% is just keeping the lights on. There's not a lot of profit in any of that. Blue line is occupancy. So you can see if the blue line is indexed on the right-hand side of the chart. So you can see we're about 95% occupancy in 2018 pre-COVID. All the pre-COVIDs in the 95% sort of range. You can see that occupancy really skyrocketed between 2020 and 2022, which is that golden period when the rates are really, really cheap, and that occupancy has been declining, which means vacancy is going up ever since. And that's really just a function of delivering a lot of units. No surprise when you look at Y over Y, that's year over year, changes in asking rents. No particular surprise that when the vacancy rate's about 5%, which is a nice, normal, stable rate, you're getting rent increases around 4% a year, which is pretty sustainable. And that when we only had like a 2% vacancy rate in 20, 21, and 22, very low vacancy rates, very high rent increases. It's amazing. We pushed through as much as 16, 14% rent increases year over year. And then as occupancy has softened a little bit, you can see that the economic power to raise rents really went away quickly. So this chart is just like a economics one slide wonder for showing supply, demand, and pricing, how they're all like very, very tightly integrated. It never comes out quite as good as this chart. This is like an unusually great one. So we're seeing that rents are flat. We thought that's probably going to last for a couple of years. I think I probably made most of those points pretty well. So what is driving all this demand? So if you take a look at U.S. population growth, it's no surprise that we've got the same problem as a lot of other industrialized countries, that our birth rate is slowing down. So the number of births in America is still greater than the number of deaths, but it's not as large a margin as it has been historically. The lighter blue line is net immigration, And you can see that most of our population growth now is actually fueled by immigration, not by more births than deaths. What's interesting about that is a lot of people who immigrate here, they're at the right age to want to go buy or rent a property right away, as opposed to if you have an older person die and someone has like a newborn infant the same day, your births minus deaths would be 0, but the new person you just added as an infant, they're not going to need to rent a place for 18 years. So not only is it favorable that we've got all this immigration helping to support our industry, but the mix of the people is also very beneficial. It's interesting, I got to go to Korea and Japan for a vacation a couple of months ago, and both of these countries are not enthusiasts of immigration, and they both have got very low birth rates, but lots and lots and lots of old people, and their population is declining. And it's really tough to have any kind of positive news in a real estate market when each year there's fewer and fewer people that demand your product. So we're very fortunate to be in America. So if you take a look at the overall employment market, which is one of the big drivers of how the real estate market performs, it's not equally distributed in its gains across different geographic regions. So if you take a look at this chart, we're going from 2019 to about a year ago, and the heavy blue line on the top is the Sun Belt region, and you can see that it's had better employment growth than any other region by a really serious margin. If you take a look at the dark line on the bottom and the light gray line, that would be like the Northeast, like New York State being the biggest of those, and legacy markets, I believe, would be the Midwest. Pretty flat for job creation. So if you take a look at the Northeast and the Midwest, flat jobs prior to COVID. March of 20 had a big loss of jobs like everybody else, and that they've since been able to recover to where the number of jobs being added and lost is the same, but they haven't done anything above the line to backfill the jobs that they've lost. If you take a look at the southeastern part of the US, they were adding about 1% to their job pool pre-COVID. They took a hit like everybody else during COVID, but by 21, they were back in the black for adding more jobs. Basically, what this looks like to me is that the jobs that were lost in the Northeast and the jobs that were lost in the Midwest were net transferred all to the Southeast part of the US. And there's not any structural reason to think that's going to change anytime soon. Brent, are you, I'm from Iowa. I think Brent's from Michigan. I mean, are you seeing that there's not a lot of population growth in parts of Michigan?
There's not, again, we have we've had a tale of two halves of the country for a little bit. So there's not exactly a drastic price reduction in Michigan yet. But in fact, there's been quite a bit of prices. I've been looking for a second home back there for a year and a half now. And, I wish I would have bought a year and a half ago is the story there. And pretty typical. But it's just, we're not seeing the big population booms like we're seeing in the Southeast and in, other areas. And Phoenix being another one, they're just getting a lot of jobs. And they are driving those lines that you have up there.
Yeah, absolutely. So the next chart here, I'll just kind of skim through this. It kind of recaps the same data we saw on the last slide, but it's only looking at high income as opposed to all jobs. And again, the Southeast, Texas, and South Florida have done a lot of growth on the high end part of the job market versus, California and the Midwest have lost the most. Two very useful things to look at. One other view of demand. I think we covered all that pretty well. So this, I think, is a great chart. So on the left is 20 to 21. The middle is 21 versus 22. And the right is 22 versus 23. And the states that are colored in dark green added the most population. The states that are colored in red lost the most. And you can see there's some pretty consistent patterns here, which just really echoes what we saw on the prior page. The main thing I want to take from this chart with you guys is that it's a gradient. So, Florida has done pretty well consistently, as has Texas, but there's also a lot of other states that people just don't think about as much. Alabama, South Carolina, Idaho, Montana, that are also really strong. And Arizona, as Brent just alluded to. Just stay out of Illinois, New York, and California will probably be all right. So if you take another way of looking at this, if you look at U-Haul's one-way market data, there are some states that have a lot more one-way traffic inbound and some states that are always losing people. So here they are ranked in 23 and 21. And then for those of you who have invested with us, you've seen in the fine print of our documents, we've got 15 primary markets that we like a lot. And then some secondaries and then some ones that we just generally, we'd have to have a compelling reason to want to invest there. And the top 10 for U-Haul overlay our 15 perfectly. So it's just one more underwriting thing that we look at, because if you've got strong job growth, particularly higher end job growth, coupled with population growth, we know there's going to be a lot of demand for adding additional capacity and taking old tired rentals that are at low rates, renovating them, getting them to higher rates, and there'll be people who can afford to take the product. So we just want to stack the odds in our favor as much as we can. I think we talked about concessions. Not a lot of growth yet, but we still expect that to happen. So talking about capital markets. So I've been really encouraged to see just in the last couple of months that some of the large institutional buyers are finally increasing their activity. So you saw in April that Blackstone bought a real estate trust of apartments for $10 billion. That was the first large transaction that had probably taken place in 18 or 24 months. Then they took another company private after that. There was an announcement here in Denver that I think it was also a $10 billion portfolio that got bought, not by Blackstone, but by somebody else in the last 2 weeks. And in April, KKR, another huge private equity firm, published a paper on why they think it's a good time to start buying. So why are they all doing this? There's something.
You know, Lon, if I may, there's a great point here, just because there's also a lot of chatter at the same time about, I've heard chatter this week, in fact, about more multifamily ending up on watch lists for banks, et cetera, et cetera. And, you know, at the same time, we have these stalwarts who have been in the markets for a long time making large deals. And you know, the two don't necessarily add up at first in the average investor, except for the fact that the media is always late. And so a lot of the watch lists and a lot of the stuff that they're reporting is, you know, 60 to 90 days late. The activity that's going on when you look at the dates is a little bit more recent. And so, you know, we've talked about this before, and, you know, where are we in the trend? And, you know, my crystal ball still isn't any clearer than yours. I've been polishing the thing up, but you know, this for me is a little bit of an indication of, you know, perhaps past the bottom, feels like a little bit past. Hard to say. What do you think?
I think that we may be, but I think there's also an artificial demand thing here. So the slide that certainly is not in here is that there's $260 billion of dry powder allocated to commercial real estate that's been raised by funds like KKR and Blackstone. Most of that, I mean, the largest segment of that is always for multifamily. And the money that had been allocated to office has been, you know, mostly prohibited, and it's all getting pushed to either industrial, retail, or multifamily. And when these guys raise this money, they've got a 2 or 3 or maybe a 4-year period where the money they've raised, they've got to get it out in the market and get it deployed. And a lot of this got raised before the interest rates started going up. So if that's the case, it was late 21 or the very first part of 22. So it's been sitting there for 23, 24. That's 24 months right there, coming up on 25 pretty soon here. If they don't deploy it, they've got to give it back. And no fund manager wants to do that. So I think there's getting to be a lot of pressure on these guys saying that, you know, we wanted to get a 17. I can find a deal that's a 15. And if I relax a couple of my assumptions, maybe I can get it up to a 17. I'm just going to go ahead and get moving because I've got to deploy this money. I think we're going to see more and more of that. Does that mean that we're past the bottom? For distressed assets, no. But for average and high quality assets, yes. I think we probably are past the bottom for good assets right now. But what do you think?
I think that's a great take.
Can you talk a little bit about the distressed project that we were looking at?
Yes. So we had a project come onto our desks here in the Denver market, which was it was 7 buildings total. Each building was 4 to 5 units. I don't remember the total count altogether, but the remaining units were basically 11 units that were nearly complete or mostly complete, and then 2 other pads, one with a fourplex that had the foundation in, and the other one was a 5-plex that was still at a dirt start. And the project was brought to us as a non-performing loan. Hadn't had any activity on the loan in 9 months, and they were looking at trying to sell the note. Of course, there was some TCO, temporary certificate of occupancy, and CO, or certificate of occupancy, issues, because the developer, who hadn't necessarily run it to the optimal it could have been, had not finished about $600,000 in landscape and lighting and other site improvements that needed to be done for those COs to be issued. And in the same time, the developer, as they kind of went down the proverbial rabbit hole, had continued to take on additional debt. So I believe there was about $500,000 in the third position that did not want to negotiate, did not want to sell anything, and basically shut off. They were the final nail in the coffin for shutting off sales. So the project came to us. Unfortunately, we are not a sponsor. So by the time we got some teams together and got a sponsor involved and stuff, we just missed out on it by a day or two, and someone else bought the note. But again, the opportunity is to go and buy a note, somewhere in the 50, 60 cents on the dollar range, be able to go through. You're going to have to go through the foreclosure process to clean off the rest of the title. And you're still going to have to go through and perform on the $600,000 plus remaining site work that the city's requiring for COs and stuff. But once you've done that, there's 11 units that are basically ready to go with just a few thousand of warranty work each, and then 9 pad sites, 4 which already have foundations in. The project itself was great, and I can believe somebody beat us to it because it was that great. I'm just a little disappointed we missed it. So, but again, you were finding those in the market, and again, they just take a little bit more to work through because they're not quite straightforward. But the opportunities are absolutely there, and we were basically looking at selling off the 11 existing homes and having the 9 pad sites for free, or if not, a profit in 9 pad sites for free.
So if you think about that capital stack, you think it was probably 60% of the project in the first mortgage, 20% in the second, and 20% down cash, or what do you think the ratios were?
I'm sorry, for what they originally did, or?
Yeah.
They had done, yes, right about that. I think they were a little bit higher, like 65 on the initial loan.
Got it. So if we can wipe out the second mortgage and get that 65% for, let's say, 32 or something like that, I mean, you're buying the project on 32 cents on the dollar. There's a lot of opportunity. So we'll be looking at projects like that. We've looked at several, some of which we didn't think made sense. This one did, but we weren't able to be quite fast enough, but that happens occasionally. Fun project though.
Absolutely.
So what questions do you guys have? We're certainly happy to try to answer anything that is on your mind on a national level, or we can try to drill down however you want. Oh, amazing. We actually had a pretty good turnout for July. Thought everybody's on vacation in Greece.
Pretty quiet crowd tonight.
Yeah.
Well, we're good after dinner entertainment for the Greeks.
Yes, absolutely.
Or those visiting.
So best states for investing is what James is asking. Generally speaking, the darker green states on here that have got the population growth, James, are probably the ones that are going to be a little bit more attractive. And then it's not probably a coincidence. Those tend to be a little bit more business friendly and a little bit less tax burdensome than the states that are in the red. Great question. So Jim is asking if I want to sell a couple C plus rentals in the Denver market and wait a couple years for demand to come back. So Jim, if they're multifamily, if you could get a buyer that would pay a decent price for them, that wouldn't be a bad idea. And then redeploy the capital for 3 to 5 years and then come back in. What advice would you give Brent if it's not multifamily that Jim's got? What if he's got houses or condos or townhomes?
Well, if he's got houses or condos or townhomes in the Denver metro, typically the first thing is really, do you have a low rate loan locked into those? That seems to be the kind of kryptonite, so to speak. If you've got a low rate loan, then usually your IRR and the remaining balance, and the low rate loan is done in that 21, 22 time period you discussed. Usually your IRR, the remaining equity, is pretty decent. If you don't have a low rate loan and you've got a ton of equity built up, again, the hard part is, the rents aren't bad, but they're not increasing anywhere near the double digits that we were. It's more in the 2 to 3% range. Your appreciation on the property is in that same, 2 to 4, maybe 5% range if you're in a really good neighborhood. But other than that, you add the two together and you're still not into the double digits. Mm-hmm. And so, if you've got a condo, townhome, or house, I would definitely consider selling it. And the only key to selling right now is the buyers don't have the money to fix things up. So you have to have them well appointed and well refurbished when you bring them to market. And if they are well remodeled when they come to market, they sell very quickly. Much, much faster than whatever your market average is for months of inventory in that particular neighborhood.
So if you're in a situation where you've got a rental and maybe you're just a little bit frustrated with all of the new laws that got passed that make it more difficult to be a landlord, reach out to one of us and we can very easily do a market study for you. We just need to know what you paid for the property, what you put in for renovation, what you think you'd sell it for now, how much debt do you have? And then what cash flow are you generating right now? And we can help you model over the next decade, what kind of wealth accumulation would you generate if you did nothing and just keep the asset? And then we can model if you sold it and paid the capital gains and invested in the stock market or medium-term income fund or a long-term fund, how would that wealth accumulation compare and contrast to just staying the course? And it's easy for us to do that. We can spend 15 minutes on a webinar reviewing it with you, and you can bring your CPA if you want to. And then you'll have all the facts that you need to know to make a really well-informed business decision about, do I hold longer or sell? So we're happy to do that for any of you guys. So it's like Jason says, our portfolio is 3.75% debt, which is probably typical of most of the people here on the call tonight. And it's about an 8.5 IRR. So we're going to sell and put the money into Ironton. Yeah, that's a typical situation where, if our long-term fund is between 17 and 20, and if you're currently making about 8.5, even though you've got the super low interest rate, we can do all the math and show you that actually over like a 5 or 10 year period, you'll come out way ahead by making the redeployment. Mm-hmm. But yeah, very happy to do that for any of you guys. It's a big part of my job.
Vaughn, there was one more question above that from James regarding Florida and issues.
So I've got a place in Florida that we bought a couple years back, and our insurance provider for the HOA decided not to renew us about 2 weeks before the end of the term. So it's really nice that they gave us some lead time. It was this mad scramble on the part of the HOA board to try to find another vendor, and we got all of one quote, and it more than doubled. So that was outside of the range of the budget by a lot. So we had to do a special assessment for this huge spike in the insurance. So that was a nuisance. I'm still glad I have the place. It still, makes sense to me. But will Florida have issues with insurance and tax costs? Yes, absolutely. The converse way of thinking about this, though, when I think about my pro rata share of the overall HOA policy plus what I have to pay just personally for flood insurance, it's about 1 or 1.5% of the value of the property. So the way I think about that, if you take 1 divided by 1.5%, that means the insurance company thinks that there's a 1 in 60 chance that I'll have a total loss in the next 12 months. I think that my odds are worse than that. So to me, the insurance feels cheap even after the increase. Looking at how this barrel storm, like we've never had a hurricane that strong this early in hurricane season ever before by like a huge margin. I think we're going to probably have more hurricane activity. So I would guess that the insurance hikes in Florida are not done. I think there'll be more of them. I think we're probably through the worst in Colorado. Just a long answer to a short question. I'm sorry.
Jason's 8.5 IRR is kind of right in the mid number of so many I see if they've got good equity in them.
Yeah, we did a couple.
I see it all the time.
We did a couple.
What was that, Nick?
I was gonna say we did a couple last week where individuals had about 4 to 5% total return between cash flow and appreciation. So it was a no-brainer for them to sell. I mean, I think what we've seen, a lot of our investors, they've owned these properties for over a decade. And as that gap, between the equity and debt continues to widen, that return on equity gets smaller and smaller and smaller. And so at some point you've got no leverage on it, but your return on equity is about 5 or 6% if you're lucky, right? And so more and more, at the end of the day, if your goal is to optimize your equity and deploy that and make more money in the long term, it usually makes sense to sell for a lot of our investors. But if you're looking to capture as much cash flow, retire, go drink pina coladas, on an island somewhere, then don't sell, right? But it all just depends on your goal. But that's what we see more and more in Denver is investors, their return on equity is in single digits at this point in time. And, just from that standpoint, it typically makes sense to redeploy it into something else.
And that's not a bad thing. What that is that we've got a generation's worth of home price appreciation between 2009 and today. What is it, like 15 years approximately? We got like 30 years worth of appreciation in just 15, and it created a lot of millionaires. And a lot of you are probably in that bucket on this webinar tonight. So the net worth you thought you'd have, 15 years from now, you probably already have it. So it's just a glorious problem to have. It's nothing that'll probably be repeated in my lifetime. So I'm just really grateful that all of us got to participate in it.
Yep.
James is asking if I looked at a commercial residential office conversion. Yes, as a matter of fact, I have in Centennial. And I met with the mayor and I met with the city council people for my region, and then one of the city council people for the region that backs up to me. And all of them see the need. Centennial has got a lot of office product, most of which is 40 years old and, varying degrees of obsolete. And they see that although suburban is doing a lot better than downtown, it's still not doing as great as it was before. And there's definitely a risk for the less efficient operators to get behind, and then they can't maintain their buildings, and then they're blighted and they look bad, and it just kind of drags down the community. So the leadership team that's elected sees this as a priority to try to figure out how do we convert these extra office buildings into apartments. So then you meet with the planning department and they tell you, look, we don't know what to tell you. We are under a zoning code that's a generation old that doesn't provide any leeway for a conversion in any kind of way that makes any kind of economic sense whatsoever. So if the city council gives us a new set of rules, we're very happy to admit it given to us, but with the rules we have right now, we can't do it. So we're in this sort of a standoff where nothing can really happen in Centennial. So the step then is you go back to your city councilman saying, here's what I heard from planning, what should we do about it? And, these city council people are volunteers and they're really smart. Like they were attorneys or engineers or financial planners, or they're all professional people and they're all smart and well organized, but none of them are zoning experts. And to rewrite the zoning code is like a colossal undertaking, and they just don't see how to do it. And if they do what Denver did 12 or 15 years ago when Denver overhauled its zoning code, it was a multi-billion 4-year project. You can talk about that. There's pros and cons to what they did. I just don't know if Centennial is going to get there anytime soon. So the problem is that James has got his thumb on this, White House briefing on some incentives to try to make this happen more often. But what you need to have is an alignment between city council, planning, and what the zoning code allows, along with some incentives that we've already got from Washington. If you get all 4 of those converge, then you're going to have the catalyst to actually see some conversion and fix the problem. But if any one of the legs of the stool is missing, you're in stasis, which is kind of where we're at right now, which is frustrating. Great question.
Assuming you can get past all the zoning and it's a clear green light, my understanding is it would be incredibly expensive for someone to actually convert that, unless, for example, there are proposed in this legislation, I believe it is. But unless you have significant government subsidies and grants to make it work, I think it's a very costly undertaking. So perhaps some have looked into it where the zoning is makes it favorable and makes it accessible, but the cost of the reality of doing such a thing, I think, is, perhaps very idealistic.
That's a huge part of the burden right there. Yeah. So getting back to what Brent opened up with, if we have this sales tax increase go before the voters and they say, yeah, I'm willing to pay an extra 0.5% on the sales tax, I'm going to raise $50 million a year. Do you want to allocate some of that to rewriting zoning codes across the metro area? Maybe you could just do it once and all the suburbs could share it instead of paying for it 22 times. That might make it a little bit more cost effective, make it go a little faster so there are more resources at it. And then maybe you take some of the extra money to provide some incentives to, maybe you offer, if the developer puts in $100 a foot of renovation, maybe the city matches the first 50%, or, maybe they match the first 50% and they have like some sort of an abatement on the property tax for 5 years. We saw that in Palm Springs, didn't we, Brent, on that hotel redevelopment?
Yes. Yes, we definitely ran into some issues there. Timeline and a few other things.
Springs has this really interesting idea. They've got some older hotels that they want to see redeveloped. So what they told the developers there is that we're going to try to streamline the process for you so it's not as cumbersome administratively. And then they'll take a look at, just from before when you start your renovation, what was the revenue and what was the sales tax that was collected from the hotel. And then you do your renovation, you raise your rates a whole bunch. So the sales tax goes up a whole bunch, and then they rebate. I think they rebate all of the lift in the sales tax. They give back to the developer for like 5 or 10 years to help pay for the renovation. And that was a way for the city to be able to induce a lot of renovation work without having to come up a lot of money from the taxpayers to fund it. I thought it was a really creative solution. That's the only city I've heard of that's done something like that. I wish that'd be more widely adopted.
Interestingly enough, in one of the red states on your slide, but they still remain very progressive.
Yeah, they really, they take a very pro-business, how do we solve the problem together approach. And you see it, like there's a lot of buildings getting revitalized, and it's really making it a more upmarket, classy place, which is fantastic to see.
Got another question here from James. Have you seen any market demand for a hybrid elder care apartment with electronic health monitoring before going to assisted living? Have you seen a price point for a standard rental?
Well, it's interesting you say that, as my dad was in assisted living before he passed away, and my mom is just in like a senior housing that's not assisted. So I get to go see a market study of this like every week on Sunday afternoon. I don't know if that's a product that's out there yet, but I wouldn't be surprised if it becomes something that could be available. The challenge that I see in my mom's facility for people that are early dementia, but at varying degrees of functionality, is that the facility is, if it's just an elderly apartment complex, there's not a lot of incentive for them to lose their residents that are paying, almost $5,000 a month for a 1 bedroom. It's insane. Would they do monitoring? The challenge is, if they monitor it, they've got to have someone qualified to look at what the results of the monitoring are and take action on it, or else you've probably created a liability for yourself, as opposed to if they're not monitored, it's not your problem. So you'd be opening an immense can of worms from a liability standpoint. If you could think through how to manage all that, you'd probably create a big opportunity for yourself. One I hadn't thought of.
I think that one requires us to be HIPAA experts.
Yeah, there'd be a lot to go into that. Well, I thank you guys for taking time out on a July evening to be with us. This is usually the worst month of the year to get anybody to participate, so I don't take it for granted that you spend an hour with us. Hope you have a great evening, and if you think of any questions afterwards, email me, text me, and we'll try to get back to you. Yep. Thank you guys for being on this with me.
Thanks, everyone.
Hey, thank you.